Moving on, last lecture we discussed about accounting concepts and conventions. This lecture we are beginning with our unit 2. Any doubts about the previous session? So we have covered purpose scope of financial statement. We discuss the users of financial statements. We talk about accounting concepts. We talk about accounting conventions. And now we're discussing the preparation of corporate financial statements as per the Schedule 3 of Companies Act. And we will talk about the statement, its amendments, its process, and so forth and so on. So let's begin today's topic. So the first thing, what is a corporate financial statement? Anybody can just help me to understand? You can put in chat box or you can unmute and tell me what is corporate financial statement. Normally, we call this as balance sheet. We called it the profit and loss account, the trading account, so forth and so on. But actually, what is a financial statement? As per the our traditional accounting methods and process, a financial statement is a summary which talks about the presentation of a data, which talks about elaboration of data in particular systematic way. So in this system or in this way, we are representing what achievements, what happens about the financial performance in whole year, and that will be very great and precise clear in presenting the overall evolution. So the financial statements are summarized representation of financial performance of particular entity. It can be a company, it can be cooperative firm, it can be large MNC or any. So basically, it is dealing with the presenting the data, giving the output, how the company is progressing. So let's continue. Schedule 3 of Companies Act 19, sorry, Companies Act 2013 provides the manner, the format in which every company which is registered under Companies Act should prepare the balance sheet, statement of profit and loss account, and notes about sale. So what is Schedule 3? So Schedule 3 talks about preparation of balance sheet. and profit and loss account. Normally, in a theory class, we teach you trading account, profit and loss account, and balance sheet. But in actual, it is only P&L account and balance sheet, which is followed as benchmark. Now, why they are not considering trading account? Because trading account is integrated in P&L account and it is considered as part of profit and loss account. Only in case I'm a production company, I will do it. Otherwise, in all cases, the profit and loss account is submerged with trading accounts. So we have three divisions. Division one, which talks about the accounting standard. Division two, it talks about the rules which are applied for entities preparing financial statements. And division three, we talk about rules which are applied for non-banking financial institutions. So the rule one, it is for companies. Rule two, it is entities who are preparing. And division three, it is rules which are applicable to the non-banking financial institution for preparing their financial statements. So the law is divided into three domains. This law, that is Schedule 3, is applicable to the companies who are registered under Companies Act. But however, this law does not apply to the companies which refer to the provision of Section 129, subsection 1, that is, any insurance and banking companies, they are not covered here. Similarly, any company which is engaged in generation or supply of electricity, or any company which is specified under Act, sorry, which is not specified under the Act, they are not applicable with this section, sorry, with this format. So, as per the rules, banking, insurance, and electricity generation, they are being ignored under this Act. So, simply, in case of insurance, they are governed by laws and process of RDA along with the Ministry of Commerce. The banking companies, they are governed by the RBI and they follow their own methods. The power generation or electricity, they are registered under the Power Generation Act and they are governed by the state and central government. And hence, in this case, the law has limited applicability to the companies which are not three: insurance, banking, and electricity companies. So please remember these words because this is a part of your MCQ learnings, what you can pretend to be. Let's move on. Now, what is the structure of the Schedule 3? It is divided into many parts. So let's understand the basic structure. The structure 1 talks about the general instructions for preparation. The structure 2 talks about the forms of balance sheet. The structure 3 talks about general instructions for balance sheet. And structure 4 talks about forms of profit and loss account. Structure 5 talks about instruction for profit and loss account. Structure 6 talks about preparation of consolidated financial statements. So the first structure is common instructions, how to prepare a balance sheet, how to prepare statement of profit and loss account of a company. The part two, sorry, the part one will talk about balance sheet. The It will talk about how we should write. So first we have to understand the basic meaning, differentiation, understanding. What is a financial statement? What are the compositions of financial statement? And how the writing part is done. Whereas the latter we have discussed about the forms of profit and loss account, its structure, and general instructions. So please remember this structure because this structure is very crucial when you are explaining the final accounts. Disclosures. General instructions to the Schedule 3 state that disclosure requirements of Schedule are in addition and not substitution. So, as per the Act, even though it is silent about supplementary evidences, about supplementary information, which will enable for understanding the structure, it discloses that whatever the additional information you required for understanding the financial statement, they are being part of Schedule 3. They are not substituted. So even though somewhere the disclosure or the content elaboration is not given, but it is understood as underlying principle of the Act that whenever the explanation is required, disclosure required, it is become an integral, sorry, it becomes an important part of the Act, even the part is not disclosed. The most important thing in the Act, what they mentioned, depending on total income of company, we are allowed to round up. So round up in next hundreds, thousands, lakhs, millions, and decimals is allowed. If the decimals are 0.50, it's a choice to convert in next decimal point or the earlier decimal points. As per the guiding principles of Schedule 3 of Companies Act 1986 and 2013 and the latest amendments, when it is 0.5 or above, it is rounded up with the next rounding amount. If it is 0.49, it is rounded up with the previous amounts. And this rounding is mentioned as a disclosure. For a proper account writing, it is being advised to maintain the non-roundup effects and carry out as it is the two paisas or two decimals for giving exact amounts. For convenience or for elaborating the cumulative reports, the facility of compounding is given. This compounding facility is enhanced. This compounding facility is benefited for report making and presentation purpose only. And when I keeping the track of records, instead of compounding, the detailed analysis is suggested. Now let's talk about the first part. The whatever things we covered are general instructions. Let's talk about the first part that is balance sheet. Now, what is a balance sheet? A balance sheet is summarized preparation and presentation of the company's financial position. It will give me an idea how the company is progressive, how the company is growing, and how it is acting for certain reasons. So when we prepare the balance sheet, we are normally being considered the format to be followed, the method to be followed, where we are using a structural way. We are following the contents in a systematic way, because if I prepared a balance sheet where I write the assets, I write the capital, I write the liabilities, I write the contingent liability, so it will create a chaos. I cannot compare it, I cannot evaluate, I cannot measure it. So a particular format of a balance sheet is need to be followed in accounting, and this format is given in Schedule 3. They talk about how the balance sheet will be. Anybody remember what is the format of balance sheet? Anybody remember the formats which you have learned?
Yes, sir.
So what are the contents on asset side? On
Machinery, that
asset side, the topmost content is what is the first content?
uh,
What is the first content?
I don't remember like sequence wise.
Mhm. Anyhow, no issue. Just give me an idea what you remember.
So machinery goes on asset side, reserve
Mhm.
on depreciation goes, doubtful debts goes on asset side.
Okay, good one. Anybody remember any other formats? Okay, not to waste the time of everybody's. It's a nice effort, and I really happy and appreciate that you remember the balance sheet. I'll just open the Excel to just show what we learned the balance sheet format. In your second semester, in your first semester, we have format of balance sheet. And this format of balance sheet and profit and loss account we have used to do the ratio analysis to understand the company's financial position. Already you have done the desk research. Already you have prepared something else called ratio analysis, financial statement analysis, and so forth and so on. So there is a particular format how the balance sheet should look like. So let me just share you. A balance sheet will be structure. It is divided in two. One is your assets and second is your liability. Balance sheet is not an account, and hence it is not divided into debit and credit. It is divided into assets and liabilities. The topmost part of asset is our intangible assets. Now, what is intangible assets? Intangible assets are those assets which are created out of the knowledge, reputation, or the goodwill which I'm carrying in the society. The example of intangible asset are first copyrights, patents, goodwills, and it can be the image building cost which is indirectly achieved. For example, if I ask you whether the BMW car or the Maruti car, which you like to have if I give it free of cost, 99% the answer will given that I prefer BMW. 1% people will only say I'll prefer Maruti. There are two reasons. One, the maintenance cost of BMW, and second is the price of petrolism, where I believe Maruti is own Indian brand. Otherwise, if I just believe the reputation of luxury, I'll more go with the BMW. And this reputation, what the BMW has earned, is nothing but a symbolic representation, what we call a goodwill. Now, my genuine question: all the celebrities, like we'll take example of Shah Rukh Khan, Amir Khan, or etc. actors, did they eat vada pav? Might be, might not be, but we never seen that they are endorsing an vada pav because they are taking care of something called status. So every company, when it's performing, it carries a certain image in the minds of people. For example, there are two malls. One is a DMart and second is Reliance Store. And both are selling a grocery like sugar, wheat, jewelry, and bajra. Which will be more preferred if the prices are same, even though the customer believes DMart is comfortable. Why? Because we got an image of Reliance in electronics and image of DMart is in grocery. So that image is an intangible assets which are mentioned on the top. Now, why they are mentioned on the first? Because these are long-term assets. They are not fixed, but they are the assets, and they are earned by spending of goodwill, by spending of the mission, vision, and principles of business operation for a longer durations. The second contents of a balance sheet is a fixed assets. The fixed assets are nothing but the assets which are used for more than one financial year. These assets are considered as producing the income for more than one financial year, and they are mostly capital in nature. They always being observed to follow an systematic method where they are being recorded with the depreciation. So the feature of fixed asset is their value remains fixed. They are used for longer durations and they are fixed assets. Then we have something called as very famous current assets. The current assets are those assets which change their value, which change their numbers very frequently. And in the end, I have something called as accumulated loss. So this is an general format of a balance sheet. If I come to liability side, the first is called as a capital block. In capital block, the first thing I'm having is equity shares, second preference shares, third debentures, and after that we have two reserves. One is a general reserve and second is a capital reserve. So whatever the things mentioned here, they are considered as the owners of the company, and hence it is considered as a capital block. It is considered as the block which is responsible for firm's investment, and they are being dealing as the prime lenders for the financial activities of that firm. Then we have something called as long-term borrowings. It can be loan or anything other. In the last, we have the liabilities. The liabilities are divided to one, the concurrent liabilities, the contingent liabilities. The concurrent liability means the creditors outstanding some wages or something, and the contingent liability means the liability which arises due to certain conditions, or the liability where the payments are honored depend on emergence of the conditions. So this is a general structure of balance sheet what we follow. Now let's understand the structure in the purview of the Schedule 3. The Schedule 3 is not something great or different. It's already what we are learning. But just in Schedule 3, we understand the writing part in more structured way or more systematically. So let's continue the first part. The first assets are current assets. An asset is classified as current asset when it satisfies any of the following criteria. So they are given the criteria which help us to recognize as current assets. It is asset which is created out of normal operating cycle. It can be traded and it can be realized within 12 months. It can be cash or cash equivalent. And the most important, it is used to settle the liability for least 12 months. So, as per these principles, the current assets are those assets which are maintained and kept for the duration of 12 months. So, they are basically type of revenue assets where the outcome or summarization is output of 12 months and it is being generated by normal trade activity. Suppose I have stock and I keep stock for 5 years. It is not considered inventory, it is considered as an investment. The second example, if I hire a car to go from Pune to Nasik, the car hired is hardly for 2 days, 5 days, 1 month, or 2 months. But if I hire car for more than one financial year, that is a 12 months, it is called lease. It is not considered as a hire. Whereas if I purchase a car and sell it in 1 year, it is called as investment. It is not called as a fixed asset. As per this, the whatever the assets which I can trade, for example, cash, debtors, bill receivable, short-term investment, short-term loans, or any other that is finished goods, same finished goods stock or raw material stock, whatever things I can trade and I can convert in cash or cash equivalents, it is the current assets. So what is the current asset? Current asset is that asset which makes, sorry, which is following criteria. Number one, 12 months. It is used for normal operating cycle. It has a trading capacity and it can be easily converted into cash or cash equivalents. I'll wait for 1 minute. Please read it. I hope the meaning of current asset is clear. Let's move on to the other assets. Okay. Items of inventory, which is consumed and realized within company's normal operating cycle, are considered as current, but which are more than 12 months, they are not considered current. For example, raw materials in store, inventory of finished goods, trade receivables, they are 12 months. So they can be easily converted into cash. But if I purchase some raw material which I'm not consuming in that 12-month cycle, I keep in hold for more duration, like 5 years or 10 years, then that raw material or that inventory is not classified as current assets. The word current assets denotes the change in value, change in usage, or change in approach, where the conversion is available in 12 months and the value is changing within the period of 12 months. So anything like mostly in case of investments, the investments which are kept shorter for less than 12 months, I can record as a short-term investments. But investments which are more than 12 months, I have to specifically record as investment. I cannot record these more than 12 months investments as current assets because their value propositions are changed for more than 12 months. So the condition of 12 months, conversion into cash and easily available for trade cycles or trade things is most essential condition to understand it as current assets. Now, before moving further, let's understand the most important concept called operating cycle. We have in accounts four cycles: one, business cycle; working capital cycle; operating cycle; and production cycle. The production cycle talks about the flow of raw material from source to final production of finished goods. So, whatever the duration, whatever the process we follow, it is called as production cycle. Whereas, in case of operating cycle, it is an duration or summary of all operational activities which a company performs within the duration of 12 months for conversion of raw material into finished goods. Whereas a financial cycle is a cycle of 12 months, but it contains the operating and non-operating income and expenditures, which are related to normal trade and movement of goods. Whereas business cycle is associated with the change in the cyclic movement, or I can say that the business cycle is a change in condition of business propositions, like it can be recession, it can be depression, it can be uh, inflation, deflation, and so on. So A business cycle is a broader concept. Financial cycle is a shorter concept. Operating cycle is more shorter concept, and cash conversion cycles are very short concept. So operating cycle is the time between acquisition of asset for processing and their relation into cash or cash equivalents. In short, when I purchase some raw material, I do the process of conversion into product and I realize that product. So whatever the trade activities I carried out, the production activity I carried out is called operating cycle. Now there is a thin difference between operation and non-operation. If you remember the cost sheet, in cost sheet we got direct wages, we got direct labor, that is a prime cost. Then we add the factory details. So whatever the things we are used, we are making expenses in a factory or at a particular place to convert the goods into finished product, they are considered as operating cycle. It is mandatory that duration of operating cycle should be less than 12 months or equal to 12 months. For any financial statements, the start and end date of financial year is mandatory to be mentioned in their disclosures. Similarly, while calculating the operational efficiency, disclosure of start and end date or the start and end date of evaluation of that financial efficiency need to be disclosed as a disclosure in final accounts. In normal cases, the operating cycle cannot be longer than 12 months, but in certain cases, they are being permitted for more than 12 months. But in such case, the declaration or disclosure is become essential. If they are agro processing or they are involved in production of certain type of goods, their duration can be longer. Here I give an example of wines because for making wines, I need to first get the raw material, put it in a drum, and store it for a long duration to make it more quality. And that long duration can be of 5 years, 6 years, 10 years, and so on. Because how much I preserve for longer duration, the ingredients are soluble and their taste will changes. And in that case, even the duration is for 12 months, they are considered as a operating cycle. In case any organization which is operating a number of products, number of different activities, and following the different locations, then in that case, each product, each place will have a different operating cycle. Simply, I cannot combine the two or more places together as single cycle. They are separate and they are identified as separate operating cycles. So, as per accounting laws, 12-month limitation is need to be operated to understand it is operational cycle. Up to deferred period, that is 18 months, the extension is available. But if except certain conditions like wines, alcohol, and certain products which are pre-mentioned in the act, I cannot cross the limit of 12 months to recognize as operating cycle. Now, so far, any doubt in operating cycle and current assets, just put in chat box. I'll wait for 1 minute. So I hope no doubts because there is no chat. So let's continue with the next part, that is current assets. Sorry, current liability. A liability is classified again as current liability if it meets the following conditions. Same like current assets, it is out of normal operating cycle. It is for the purpose being traded. Again, we have condition of 12 months, and company do not have unconditional right to defer the settlement of the liability for the last 12 months after the reporting date. Now, the first 3 points are very precise and clear. We already know these principles. Those who have done the commerce, they are well aware of the first 3 points, that the current liability is an outcome of company's regular activity. It is not something of capital investment or any other investments. The settlement period for current liability is of 12 months. The current liability is always been an unconditional, but in case of settlements of this liability, it is mandatory to follow the 12 months period. So, for current liability, we have the special condition that unconditional right to defer the settlement for more than 12 months is not available. So, in case of current liability, like in assets, we can have a deferred payment, but in liability, we are not being authorized, we are not being permitted for more than 12 months. Whatever the outstanding, whatever the responsibilities which are available or liable, I need to take care. They are being authorized only for 12 months. If more than 12 months, they are considered as short-term borrowings. So if the assets are meet with this, it's a current liability. Now let's take an example. We have a salary which is outstanding. We have something called as wages. They are outstanding. So the salary and wages, they are of my regular activity. They are for the period of 12 months. But since we follow the accrual principle, that is paid or payable, whichever is the first, we count them. And in that case, it becomes my current liability. If suppose I have a loan and that loan has a terms and condition for repayment within the period of 12 months, so I can consider that as current liability. But if the loan has terms and conditions that I have to repay in 5 years or 10 years, then the benefit which I received is current financial year, but the repayment is more than one financial year. So it is not considered as current assets. It is considered, sorry, current liability, but it is considered as a long-term liability. So 12 months condition, settlement in one financial year, and application in normal work operation is very crucial in understanding it as our current liability. Now, let's move on to the other. What is a format of balance sheet as per Schedule 3? I'll wait for 1 minute. Just go through the format. Now, if you see the format which we have done in our syllabus, which we followed in our syllabus, and the format given here is slightly different. Now, what is the difference? In our syllabus, we follow a format of T where the one side is asset and second side is a liability. But in actual practices, in case of businesses, we always follow this format where we have first block of capital and then we're following notes. We have the figures at the end of current period. So here we show the current period and the second last column will show the previous period. For example, if the current year is 2026, then the previous year will be 2025. Now the question is why the 2 years are disclosed in any format? The purpose is a comparison to show the accounting consistency followed, to show the change in accounts. Because when a normal layman refers to the final account, he should able to understand what is the earlier structure and what is the current structure. Whatever the changes, whatever the upgrades, he will able to compare. Now, for example, in previous year, the capital was 2 lakhs and now the capital is 3 lakh. I understand 1 lakh more capital is added in the company. Suppose in earlier year, there was current assets 1 lakh 50,000 and now the current assets are 3 lakhs. It means the amount of current assets they are increased by 50%. So comparison, structure analysis, and checking the efficiency of organization, these 2 years are very crucial. On the top, we always mention something called name of the company. We never mention this part of format. We write first name of the company. If you remember when I given the format of balance sheet, I always emphasize to write in the books of XYZ. Now that in the books of XYZ means suppose I'm preparing balance sheet of Tata. Then I will write in the books of Tata the balance sheet as on so and so date, and then I have to mention the currency denominations. If I'm doing it in India, it's Indian rupees. If I'm doing it, suppose in other country, whatever the currency, I need to mention. Now there is a curious question. Can I make balance sheet in dollars? Yes. As per Indian accounting standards, you can create a balance sheet in dollar subject to condition. All your transactions are marked, valued, and vouched in dollars. I can even do my transactions in Australian dollar, Singapore dollar, or Chinese yuan or pound, but my all transactions are recorded in that currency only. If suppose I'm selling the goods in Indian rupees, then I'm not authorized to record the transaction in pound because whatever the currency which I'm dealing should be uniform and follow the particular pattern. Just because to influence the globally. So for any company, dollar, pound, yuan, or rupees, freedom is yours. But in local markets, if you're operating that currency, then only you're permitted to list out in balance sheet. The one difference here is in accounts, when you write in books, we have something called as ledger folio, journal folio. But in case of the format, we're not writing something called as LF, that is ledger folio, or we are not following something called as JA, journal folio. But we are writing something called as note number. Why? Because when we write the accounts of company, we have certain disclosures. Suppose I'm writing equity and liabilities. They will be always having some explanation, some disclosure, and that all disclosure numbers are mentioned as note. Note 1, note 2, note 3, note 4, note 5. Please remember, all these notes are related to the current financial year. They are not about previous financial year. The columns here shown why there is no label here because in a format of balance sheet, they are classified as per the blocks. So if I write the serial number and classify as per the blocks, it leads to an presentation in serial number to a misconception. And as per the accounting standard one or as per the disclosures of Companies Act, serial number is an integration where it will become unnecessary complications because if I have the equity and I don't have non-current liabilities, then I need to maintain and then keep the column blank. So it will create a confusing, so it create a cohesive environment where the formats will be unclear and the people will not understand the balance sheet. So the serial number is avoided to be mentioned. Now, most important, if suppose the previous financial year is ended less than 12 months, and if the current financial year is of period of 12 months, then I need to have a separate disclosures while mentioning the dates. Because if this year is for 9 months and previous year is 12 months, or vice versa, I need to take care that the activity are of similar period. If they are not similar period, then the disclosures or accounting notes should have a proper explanation, and this explanation should be endorsed by the board of directors and internal auditors. Now let's talk about the structure of a balance sheet. It contains first equity and liabilities, where I have to mention the equity shareholders, the capital. Now, the capital is illustrated. Let me just show you. I have authorized capital. So this is my authorized capital. Out of authorized capital, I will issue the some part and I'll keep some part. So I have some called issued capital. Out of issued capital, people not purchase everything. They will keep some balance. So some part which is paid by people, it is called as a paid up capital. When the people are paying the capital money, they are not paying fully. They are paying partially. Like if the value of capital is 100 rupees, they might pay 80 rupees. So this is subscribed capital. And if suppose the capital is enlarged or more, then the difference is recognized as premium. If capital is short, then the difference is understood as discount. So all these things we understood in our accounting system. So everything is mentioned here under the term called share capital. Then we have second block which talks about reserve and surplus. Now, my dear students, there are two types of reserves. One is a general reserve, and second is a capital reserve. A general reserve is an outcome of the revenue, the income, and other things, whereas the capital reserve is accumulated funds which we are using for understanding the future needs and application for the same. Now, in case of general reserves, they are utilized for general purpose or revenue trade activities, whereas capital reserve is utilized for my capital trade investments. Now, it's almost time for the next session. So, just quickly revised, we talk about current assets or and current liabilities. So current assets and current liabilities are those assets or liabilities which are for 12 months. They are out of trading activity and they can be easily realizable or accessible regards to the trade. Second, we talk about the operating cycle. Operating cycle is a cycle of production, which is the conversion of raw material into finished goods, and it is normally of duration of 12 months. Then we understand the contents like balance sheet. We talk about the first structure, that is equity capital and liabilities. So we'll continue this discussion in next session of financial reporting. Now you got a session about strategic management. Please report for that session. And one suggestion from my side, please rename yourself in proper format. Yogeshwari Davde, you're not rename yourself in proper format. If you want to record your attendance, then you need to follow the same method. So now you can log out and we'll meet at 8 p.m. for my next session on international finance. Thank you for being part of this meeting. Now, please continue with the common subject session. Thank you.